You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
Happy Saturday, East Tennessee, and welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI, and today we're going to talk about volatility versus opportunity. What should investors be doing this fall? How should you be adjusting your financial planning? You know, as leaves begin to fall, we head into autumn. Historically, fall markets have been known for heightened volatility. Certainly 2025 has been an interesting year. We had heightened volatility, especially early in the year. However, the markets have continued to surge to new highs, and I hear more and more people in the community, at my classes I teach, in my office, concerned about, can it keep going higher, and expect more market volatility soon. But successful investors understand that market volatility isn't something to fear. It's an opportunity to rebalance, to refine your plan, and potentially strengthen your portfolio for the future. Recent data shows that investors who remain fully invested through volatile periods earn significantly higher returns than those who try to time the market. With proper planning and a disciplined approach, you can turn market turbulence from a threat into strategic advantage. So today we'll explore how to navigate market volatility with confidence, understand when should you be rebalancing, how do you stay focused on long-term goals. And we know panic selling is often the biggest mistake investors make, but how do we prevent panic selling? Because it's an emotional response. We'll talk about strategic but rebalancing, and, of course, portfolio diversification, and how the income plan in retirement can help you plan for the effects of short-term market volatility. So we'll try to answer your common questions about managing volatility and discuss proven strategies to help you stay on track toward your financial goals. So let's understand market volatility. It can trigger strong emotional response, as we know. It often leads investors to make decisions that they later regret. Understanding why markets move the way that they do, and more importantly, understanding your reactions to those market moves, is the first step to becoming a more successful long-term investor. And part of that, too, is understanding risk and the potential volatility in your portfolio before it happens. Today, we'll explore what recent volatility and why the biggest risk really isn't market itself, but it's how we respond to it. You know, I've had 2 meetings this week with people in the community who came in and wanted to have a consultation. I had 2 different people this week that had been sitting in cash for, or had gone heavy into cash over 12 months ago, out of the concern that markets, hey, Jim, you know, I mean, we saw over 20% gains each of the last 2 years in the S&P 500 coming into 2025. There's no way we can continue to hit these new highs. Well, what now? I mean, markets are up 16, 17% this year through the end of October, through yesterday. So if you've had a bunch of cash that's been sitting on the sidelines, what do you do now? So how do we unpack all this? You know, we kind of expect solid but unspectacular gains if we're looking out the next 5 or 6 years, if we look at things like price to earnings ratios of U.S. stocks. We have to realize that 2024 was an unusually placid market. The biggest pullback in the stock market in 2024 was only 8.5%. Now, we saw a double-digit correction earlier this year. We saw an 18% decline in the S&P 500, and that was due to the tariff thing. Markets were already down some from the peaks early in the year through the end of March, and then the tariff proclamation in April caused tremendous market instability, but it came back very, very quickly. Was that a true correction in terms of how we define market corrections? It was. The market was down more than 10%. But how much of that was artificially driven through the tariff concern? And it did come back very, very quickly. So we have to remember bear markets. Let's define these terms. A bear market is where the market goes down more than 20%. Since 1900, that happens about every 6 to 7 years. And the average is about a 35 to 40% downturn. Our most recent really bear market was 2022. We did end up hitting some bear market status at some point during the year. For the year, the market ended up down a little less than 20%, but it did exceed a 20% loss, but barely. It didn't go much above that, where the average is more like 35 to 40%. Periods of frequent 2% movements per day, when we see the stock market move more than 2% 2 days in a row, up or down, those types of swings are typically driven by economic uncertainty. And it emerges around concerns about impact on the economy and corporate earnings. And ultimately, just remember, in the long term, all markets care about is corporate earnings and growth in corporate earnings and projected growth in corporate earnings. The market is apolitical. It's looking at corporate earnings. And investors often overreact during periods of uncertainty. We've got this interesting dichotomy that's happened for most of this year, where investors, by and large, are not really real confident. Consumer confidence is kind of low. Business confidence is fairly low. But that's what people think about what may happen. When we look at data and look at what has actually happened, every month the data comes in, and it's been pretty strong. U.S. corporate profitability continues to remain strong. Now, we are seeing some pullback. We are seeing some slowdown in the economy. We are seeing lack of job hiring. We are seeing a boost in inflation up to 3%. So it doesn't mean there's not some data that is concerning. I'm just letting you know that we have to be careful because investor behavior and market reality are often two different things. And there is a cost of market timing. Now, when we talk about market timing, I think we have to be very careful. Everyone understands it's not good to try to time the market. But the human emotion of it is when markets change and are volatile, people tend to make rush decisions. And that is a form of timing the market. And the reality is, if you miss just the best 5 days in the market over the last 20 years, it would cut your annualized return almost in half. And the best days in the stock market historically often come following the worst days. Political investment decisions also significantly underperform staying invested. So, emotional investor behavior, volatility makes us feel uncertain and fearful. It often prompts rash decisions not in our best interests. And many times it can lead to the ostrich effect. Some people just want to bury their head in the ground and do nothing. And then panic selling, of course, can always be very, very dangerous. So how do you really plan for this? I mean, market volatility is an inevitable part of investing, but it doesn't have to derail your financial goals. Understanding your own emotional responses and having a plan in place before it comes and before volatility strikes is crucial for long-term success. Navigating volatile markets requires more than just emotional discipline. It requires a comprehensive strategy tailored to your specific situation and goals. So as financial professionals, we help clients develop investment plans that account for volatility while keeping you focused on your long-term goals. So whether you're concerned about, potential market movements, wondering if your portfolio is properly positioned, or looking to develop a more disciplined investment approach, we can help you create a strategy that works through all market conditions. So one of the things that you've got to do is plan for market volatility before it happens. We know that measuring risk, how do you measure risk in a portfolio? Measuring risk is looking at a current mix of investments. And typically we're going to have to look at historical data. We're going to have to look historically at how that portfolio would expect it to move when the market's up, when it's down. What are the potential ranges? What are the potential ranges of outcomes in the future? And we know we can't predict the return, right? We know we can't. Is the market going to be up? Is it going to be down? Are we going to, how much are we going to make? How much are we going to not lose? But the reality is, risk can give us a pretty good understanding of if X happens in the market, what would you kind of expect your portfolio to do? Now, it's not a foolproof thing. We know that. Markets are never predictable. We never can predict the future, but we can have a pretty good idea. If we had one of those 35 to 40% bear market downturns that we typically see every 7 or 8 years, how would that likely affect our portfolio? We can start to get our arms around that a little bit through measuring risk. And then how we structure our plan. When are we going to need our money? If I'm 30 years old and I have a 401k, should I be worried about short-term market volatility? I'm really not worried about what the markets and my investments are worth next month or next year or even in 5 years. I'm investing for 30 years from now if I'm 30 years old. If you're retired and you need retirement income, you need long-term growth. And the stock market has been historically the best way to beat inflation, but in the short term you get volatility. How does that affect your income need? All these things are important. And when you have a comprehensive plan that's tied together, and you connect all these dots and understand how the investment plan relates to the income plan, how do you incorporate tax planning if you're going to be doing Roth conversion? How are you going to pay the tax on the Roth conversion? And what if the markets are down and the money is in the market? You don't want to liquidate that when it's down to pay the tax. There's just so many components to this. And so having a comprehensive plan, measuring volatility, and understanding when are you going to need certain pieces of money and positioning that money appropriately is so important in managing volatility and maybe most importantly, managing the emotions we feel during market volatility. So when we come back, we're going to talk about the power of staying invested. But how do you do that? And again, it goes back to measuring risk, having the right kind of plan, but we'll dive into all of that. You can also check us out online. Go to broganfinancial.com. We got lots of resources. You can also click to sign up for a complimentary consultation. Again, that's broganfinancial.com. When we come back, the power of staying invested. How do you structure things to where emotionally you can handle that during market turbulence? So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living right here on News Talk 98.7 WOKI. I'm Jim Brogan, and today we're talking about the power of staying invested during market turbulence, how to plan for market volatility before it happens. One of the most powerful lessons in investing is also one of the hardest to follow. How do you stay invested during significant market downturns? The data is overwhelming. Investors who remain invested through volatile periods significantly outperform those who try to time the market. So I want to explore a little bit why missing just a few key trading days can devastate your long-term returns. But then how can you position yourself You've got to be sure to capture gains no matter when they occur. And see, that's the thing. And if you look at the cost of missing the best days in the stock market, J.P. Morgan ran a study, 20-year study from 2004 through the end of 2024. If you were fully invested in the S&P 500, you would have earned an annualized return of 9.9% per year, compounded. And so 9.9% per year over 20 years. If you had missed just the 10 best trading days in that 20-year term, just the best 10 days, it would have reduced your return to 5.5% per year. It cuts your growth almost in half. The best days often occur during the most volatile periods and often after the worst days. Look back to the tariff proclamation, day in April. Markets were cratering. Everything looked bleak. I believe it was a Tuesday night where there was some pressure on the bond market out of Japan particularly that was going to cause interest rates to rise on 10-year Treasury notes. And that puts tremendous political pressure and trading and fiscal pressure on Congress and the White House. And what do you know, Wednesday morning, if I'm remembering correctly, we had a pause in the reciprocal tariffs, and the markets shot up almost 10% in one day. So many investors thought things looked awfully bleak then. But look at what happened. And if you had not been in the market in that one day, look at what you would have missed out on. So we have to be very careful. If we look at 2025, if we look at the volatility index called the VIX, it's really kind of a fear gauge. It's associated with increased perception of risk in markets. And it's been a little higher for much of this year due to, tariff uncertainty, deglobalization, geopolitical concerns, interest rate concerns. The current environment in 2025 has in some ways, when we look at the fear index, the VIX, it's kind of echoed 2018 and 2019 U.S. and China trade war concerns. But how can you make sure that when we have these periods of extreme volatility, you don't see too much of a decline? Because one thing I'm going to talk about is the volatility tax. There is a tax on big market downside volatility, and we've got to fundamentally understand that. But before we do, let's talk about the power of diversification. If I just go back to this earlier this year, the S&P 500 was down 18% from its peak. And just the traditional portfolio of diversified stocks and bonds, if you had a 60-40 mix, was down about 7% in that same period, so 7 instead of 18. Furthermore, if you had even greater diversification and had international stocks and had alternative asset classes like real estate and natural resources and commodities and other things. So you have more in your portfolio that if one thing zigs, another zags. You could have potentially been down even less. 4 or 5%. We saw many people down 4 or 5%. So now you never know. It's everybody's individual portfolio. Don't want to talk about specific returns. We know that portfolio diversification can help protect you on the downside. And what that means, what is diversification really? Many people think if you're in the S&P 500, you're diversified. Well, first we have to look at diversification within the category of stock market risk. Let's look at U.S. stocks in general. Are you diversified within the U.S. stock market? And so what that means is you don't have too much certainly in one company. That's what we mostly think of, is you don't have too much money invested in one company where that one company's performance could upset the entire apple cart. But it also means you don't have too much in any one industry group. You're spread around. You've got different size companies. It's all of those things. And the S&P 500 has become so dominated by the big technology stocks. If we look at the top 8 stocks in the U.S. market right now in terms of the largest companies, They're all technology stocks. We think about NVIDIA, Microsoft. There's the Mag 7. There's also Broadcom. Those are all, have elements of AI and technology. Now, I'm not saying it's not justified. Those companies have had greater profitability and greater revenue growth than the other 492 companies in the S&P 500. But the top 10 companies in the S&P 500 impacts 40% of the movement of the S&P 500 index. So are you really diversified in the U.S. stock market? But then there's this is the main thing I want you to hear, there's a greater level of diversification that's needed. I mean, if you're truly diversified in the stock market, then if the stock market, well, I really shouldn't say if the stock market, when the stock market goes down 35 or 40%, what do you think you're going to do? I mean, if you're diversified in the stock market and the market goes down 35 or 40%, you're going to probably lose close to 35%. I mean, we don't know for sure. We'd have to look at the individual portfolio, but more than likely, we've heard this the expression, "a sinking tide sinks all ships." So a greater level of diversification would be to have more things other than just stock market assets. That when one thing zigs, another zags, and that way, when one thing's way down like stocks, hopefully they're not all way down. So, when people come into our office, I can't tell you how often I see that 60-40, 70-30 mix of stocks and bonds. And when I really dial into it, most people, if we slice it up a little bit more finely, have 3, maybe 4 asset classes. They've got large cap U.S. stocks. They might have a little bit of international stock. They might have some small company stock, and they've got U.S. bonds. Many only have 2 or 3. And the bond market, if you look at a portfolio of 60% stocks, 40% bonds, it still moves up and down with the stock market. I mean, that portfolio is still over 90% correlated with the stock market. And bonds historically weigh on performance over time. I'm not saying don't own any bonds, but they're very dangerous over longer periods of time in beating inflation. So instead, you own more things. You own things like real estate and other alternative asset classes. You've got good international exposure. You should own volatility. When things are really bad and we have tremendous downside volatility, you should have, you put $1 in and that dollar turns into $10 or $12 when the market's down 30 or 35%. Now that means that if the market's not down 30 or 35%, you've spent $1. And that's going to produce a drag on your performance in booming markets. So what happens is when you have a greater level of asset class diversification, you have more things that zig and zag. Instead of having 2 or 3 things, maybe you have 8 or 9 things. The idea is that you always have 2 or 3 or 4 things that are doing pretty well or holding their own, even when markets are bad. But now the flip side of that is that when markets are booming, you're probably going to own a few things that are not doing as well. So you're not going to make as much in the boom. So it's really important to understand that when you add more asset class diversification, yes, you have the potential to reduce volatility and the risk of downside loss. But, if you're going to have a portfolio that's likely not going to lose as much in the market downturn, then you're probably not going to make as much in the market boom. So, if you're 30 years old, and I'll go back to that. Let's say if you're 40 years old and you've got a 401k and you're not going to touch that for at least 20 years, then I would argue you should have mostly an equity-based, if not entirely an equity-based portfolio, because stocks and stock funds the stock market has been the best way to fight inflation over 20 and 25-year periods of time historically. But when you're approaching retirement and you're going to need to draw income from those life savings and you're going to need to start selling investments or generating income to have income, then your time horizon is not 20 to 30 years. And so you have to be careful about volatility because a 30 or 35% downturn can be devastating if you don't plan for it properly. Now, one key part of this is to understand that volatility is part of the game. So you need to maintain a long-term perspective, but you also have to understand, you don't need to be selling investments when they're sharply down to generate income where you spend that money. Rule number one, or one of the top rules of wealth management, is don't spend a substantial investment loss. It's okay to sell something when it's down and reinvest it, but you never want to sell it and spend it. Do you have some more stable investments and assets that you can use and spend and use for income when markets are volatile? That's a key part. Having an emergency of cash reserves is also very, very important. And there's nothing like having a healthy margin of safety in your portfolio when you have short-term cash needs, short-term income needs. And that allows you to stay invested through diversified portfolio measures. You can stay diversified. So tell you what, we're going to get to our next break. When we come back, I want to talk about what we could call the volatility tax. Many of you have heard me talk about the cruel math of losses. I'm going to talk about it a little bit differently. When we have extreme downside volatility, when you get up over a 30% loss, the volatility can be devastating. So when we come back, let's talk about the volatility tax, and then we'll also talk about strategic rebalancing. We know we should buy low and sell high. How do we do that? Structurally, how do we do it systematically? How do we do it emotionally? Stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI. We've been talking about, we know the power of staying invested through market turbulence, but that's easier said than done. We have to manage our emotions. And so today we're talking about, on the one hand, what is the importance of staying invested? But then, how do you practically put things into place where you can stay invested? Part of that is how you measure diversification and risk. Part of that is understanding fundamentally diversification. Part of that is understanding risk before it happens. So you don't get, we're going to have market volatility and we're going to have bear markets. It's just a fact of, the two things I feel certain about with the markets is that they're uncertain and that they're volatile potentially. And so we shouldn't be surprised when we see market volatility. So let's talk about the volatility tax. Now, this is radio. You're not getting a visual. If I could have a chart and draw this for you, it would be even more clear. But I think I can walk you through this. I want to talk about the volatility tax. What does that mean? When the deeper a loss is on an investment or a decline, the more you have to make to recover that loss. So, in other words, the deeper the loss is, the harder it is to recover. And let me explain it this way. Let's say that you have $100,000 and you lose 50%. Now, granted, 50% is a market anomaly. That happened last in the Great Recession. We lost over 50%. But let's just use that as an example of the volatility tax. If you have $100,000 and you lose 50%, you now have $50,000. Now, if you have $50,000 and you make 50%, what do you have? You've got $75,000. So you're still down $25,000. Your average return for those 2 years is zero, right? Plus 50 minus 50, the average would be zero. But you're down 25%. That's a volatility tax. Now let's do more math. What if you lose 33%? So if that's harder math, let's do 25%. Let's say you're at 100,000 and you lose 25%. Now you're at 75,000. If you make 25% on 75,000, you're now at about 92,000. $92,500. Okay, so or about 93,000. So now that's still an average return of zero. You're still not break even, but you've lost 7%. So your volatility tax is 7%. Whereas if you lose 50%, your volatility tax is 25%. I hope you're following me here. It becomes very difficult to manage short-term volatility if you have, if you're going to need income in 5 or 6 or 7 years from your risk investments. When you get up over a 30% loss, it can be very, very difficult and challenging to see that money not only return but also beat inflation because it takes a lot longer to recover a loss than it does to suffer a loss in most instances because of this volatility tax. So that's just kind of a reality we have to live with. The closer you get to retirement, there's usually, with most people that we meet with, there's a need to reduce volatility in a portfolio. But it's simply a measurement of risk and reward. How do you structure income in the short term? How do you protect? We know we're going to have market volatility. How do you protect your financial plan against the impact of that short-term market volatility? So next, I want to talk about strategic rebalancing. We hear that a lot. How often should you rebalance? One of the world's oldest investment pieces of advice is what? Buy low, sell high. But in practice, that's incredibly difficult for most investors to do because emotions often drive investors to do the exact opposite. I mean, when we hit 20% or more losses in the stock market, that's when there tends to be blood in the streets and people start to get really, really scared. Think about the fundamental balance or the fundamental idea of rebalancing a portfolio. Let's say that you own 5 different investments at 20% each. And a year from now, some of them have grown, some of them stayed the same, and some of them have maybe lost money. All right, so let's say the best performing asset went from $20,000 to $25,000, and the least performing asset went from $20,000 to $15,000. So in a rebalance, you would sell off $5,000 of the winning investment to cut it back to 20%, and you would take that money and buy another 5% of the more poorly performing asset. That's what rebalancing is. Well, that's very hard emotionally to do. I mean, we're going to sell off the winner and buy more of the loser? That doesn't sound like a great proposition, yet that's what rebalancing is. So how should you approach rebalancing? In my view, most people rebalance too often. The research suggests that we should rebalance less often, not more often. And the reason for that is I do believe in my studies of the markets over the years, I believe in the power of momentum. And, if you rebalance every single quarter, or God forbid every month, but even every quarter, you tend to choke off. Every quarter you're selling off a little bit of the highest performers and buying more of the lowest performers, and you tend to choke off momentum of asset classes. Okay, but at the same time, you don't want to get that out of hand. You don't want your best performing asset to get so large that now you've got a risk exposure. What if it doesn't perform as well? And many ways, retirement planning is about managing risks to that retirement outlook, stability. And so, if you're doing it too often, it can be harmful. I don't even believe you should automatically rebalance. You maybe could do that every year. I don't like setting anything like that up automatically. I'd rather just kind of track things, and when things start to get out of balance too much, then you make a move. So you just have to be careful. But, we need to understand things. I mean, 70% after we see a 5% pullback in the market, 5% of the time the market a year later is higher. So, volatility-based reinvesting and rebalancing can be effective. If you're setting yourself up for an automatic rebalance periodically, are you positioned to take advantage of a market dip and rebalancing more and to take advantage of that volatility? And so I think that you have to monitor your portfolio very regularly. I think you have to be careful that you don't be buying and selling too often. Research does not support the idea of doing that regularly over time. So I think you look at it on an ongoing basis. Calendar-based rebalancing to me is less attractive than volatility-based rebalancing, and by following things manually. You can also take advantage of tax planning when markets are down and when markets are up. Typically, if you have some investments performing better than others, which is inevitable, there's often tax advantages that you can take advantage of, whether that's gain harvesting or loss harvesting. All right, and now if you're a retiree or soon-to-be retiree, you may have a different rebalancing plan than someone that is just saving and accumulating money and who is younger, who can afford more risk. They might want to let momentum ride for a longer period of time because they might be willing to take more short-term risk, whereas if you're closer to retirement and you need retirement income, you might need to really keep your arms around your mixes of your different investments to make sure you don't get too out of balance. But how long has it been since you truly looked at the balance in your portfolio? Many of you, in a 401k, you might kind of set it and forget it, but that can be very dangerous over longer periods of times. How do you know when a portfolio has drifted too far from its target allocation? You only know that by monitoring it periodically. What is periodically? I mean, I would say you should be looking at your portfolio at least every quarter. I'd be a fan of at least looking at your monthly statement, but certainly every quarter. You don't want to bury your head in the sand. That's that ostrich effect, because things can get away from you really quickly. You've just got to keep an eye on it. You do have to look at the tax implications of rebalancing. The great thing is, if you're inside an IRA or retirement account, you don't have to worry about tax implications of buying and selling because it's all, sheltered from income tax. But if you're outside of an IRA or 401k, you do have to worry about the tax ramifications. The bottom line in all this is rebalancing can be one of the most powerful tools in your arsenal, but it can also be overused. It requires discipline, careful consideration of tax implications. What are the timing implications? When it's done strategically, we can take advantage of volatile markets and significantly impact our long-term returns. But it's more than just understanding the concept. It's understanding emotion. It's careful analysis of your current portfolio, having the discipline to act when emotions are screaming to do the opposite. So whether you have it rebalanced in years, or your portfolio has become overweight in certain areas, or you're looking to take advantage of market volatility, we're here to help you when we look at that kind of stuff. So, that's what I do on this show, is try to give you great ideas so you can make informed and prudent decisions that can impact the quality of your life. Now, next, when we come back from our last break, I want to talk about being confident about retirement. I'm looking at some new study here that I'll get into. The majority of mass affluent Americans feel ready for retirement, but few have factored in inflation, healthcare costs, and the true need for a financial plan. So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living here on News Talk 98.7 WOKI. I'm Jim Brogan. Thank you for tuning in. We're with you every Saturday, 9 to 10 a.m. and then again from 3 to 4 p.m. You can get all our podcasts. We post them all. We'll have today's up probably by Tuesday afternoon as typical on Spotify, Apple Podcast. You can also stream our shows directly from our website, not live. You can do live streaming at 987newstalk.com. You can stream after the fact. We've got all of our shows posted there from the last several years. Go to broganfinancial.com and you can click on radio. Check us out. Check out all our resources. We got a great resources tab of reports and studies and white papers. You can also follow us in our blogs, follow us online. You can also register for our email newsletter, where we'll send you out once a week. I'll send you an email where I just give you links to different content we've created, whether it's a white paper, a blog, an appearance on Bob Yarbrough or one of the other shows or whatever it is. So do check us out. A new global survey from Prudential Financial suggests that while a large majority of mass affluent Americans feel confident about covering essential expenses in retirement, many lack the concrete plans and professional guidance that could help turn optimism into reality. So the poll, the 2025 Global Retirement Pulse Survey, it polled 4,200 mass affluent adults across the globe, U.S., Mexico, Brazil, Japan, found that 89% of U.S. respondents believe they will be able to cover their basic costs in retirement. Now let's break this down a little bit. What is the mass affluent? I would define that as the typical person who, upper middle class, approaching retirement with some confidence and some assets that they can navigate retirement. Typically, I would say this is people with an investment base of between $1 and $5 million, and that's the mass affluent. That's the biggest chunk of clients we serve. We serve some clients less than that, and we serve a good bit of clients over that. I would say the mass affluent is 1 to 5 million. So 89% of U.S. respondents believe they'll be able to cover their basic costs, yet only 61% work with a financial advisor. Only 1/3 have a retirement plan, a financial plan. And so we would call this a confidence paradox, where there's high optimism but relatively low adoption of the best practices you may want to have in place for retirement security. So many people feel ready, far fewer are taking action to ensure that they're ready. Confidence is closely tied to planning and advice. Those who work with an advisor, 94% are confident they can cover essential expenses, compared to 83% of those who do not. The gap is even wider for non-essential expenses. Now, I'm not saying you have to have an advisor, but if you have an advisor, you're more likely going to have a plan. Do you have a written plan? Do you have a plan not just of how to invest the money, but how to draw income, how to tax plan moving forward, how to be intentional about the taxes you pay, how to measure risk? What's your estate plan look like? What's your Social Security election? All of those things are so critically important. And despite the overall optimism, the survey reveals that many mass affluent Americans have not factored in key risks such as inflation and rising healthcare costs. 66% of those respondents say they're concerned about inflation. 62% are concerned about rising healthcare costs, but only half have considered the threats of that in their financial plan. So having a good plan and understanding how this is connected, how to mitigate the risk of volatility. We've talked about many of those things on the show. Having a plan and measuring these things and monitoring it, whether you do it on your own or have a fiduciary that does that with you or for you, is so critically important. Thank you for tuning in this week. We've discussed your wealth, because greater wealth provides for more living, so you can live the best years of your life your way. Thank you to Wayne. Thank you to Mary Caroline. Have a blessed weekend. Let's go Big Orange. You're listening to More Living with Jim Brogan here on News Talk 98.7 WOKI.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.